Hello, friends. Welcome to another episode on Consulting Interview Prep with me, Nilay Bhatnagar. In this episode, we'll take a closer look on how to apply the private equity framework that we learned in the previous video to a real McKinsey case. So, without any further ado, let's dive right in. So, today, your client is a private equity firm called Vitamin Universe. They are a chain of vitamin health product stores. Before finalizing their bid, they've asked McKinsey to analyze the industry and give an opinion on whether or not they should acquire this company or buy this company. Now, Vitamin Universe owns about 1,000 stores. They are spread across the US and they are mostly located in shopping malls and strip mall shopping centers. They sell a wide assortment of products, including vitamins, minerals, herbs, sports nutrition, etc. They also sell a limited assortment of food products like nutrition bars and diet drinks. So, our client, the PE fund, is asking us whether they should go ahead with the purchase of Vitamin Universe. All right. So, as usual, we'll quickly cover some clarifying questions. Then you should pause this video, take a couple of minutes, and then join me as I discuss the approach or the structure we can use. So you can see this is a McKinsey case, but I do have more than the usual number of questions. And the reason is generally with private equity cases, you would want to have a little more information about the target company, right? And also the financial objectives and the underlying motivations of why your client is interested in this company in the first place. Okay. So let's quickly cover a few important questions. The first one is scope related, right? So now, as we heard from the prompt, sounds like they have at least two distinct categories of products. One is vitamin supplements and other things like minerals and herbs, and second is, although it's a smaller product line, it's more healthy foods like sports drinks or energy bars, right? So which industry do they want us to focus on exactly? Right. Second, and this is probably super important, second and third actually combined, is what are the underlying motivations of this acquisition? Is it like a turnaround management kind of situation where we are looking to actually turn around this company? We believe it has potential if we can just turn it around and improve its operations, right? Is it a platform kind of deal where we believe in the potential of this company? This company is already doing pretty well and we want to further accelerate its organic growth. Or is it like an add-on kind of acquisition or deal, right? Where we want to maximize the synergy potential between Vitamin Universe and some other portfolio companies. Right? And similarly, once we understand this, it would be important to understand how does our client think about success on this deal? What are the success factors? Is it like the exit multiple, the number of years it takes to get here, whatever? What is the success criteria for the client? It's super important to know that. The fourth area, I just want to check about Vitamin Universe's business model, right? So I know they have a bunch of different products, but I am really interested in what is Vitamin Universe really known from. From the brand name, it looks like they're known for vitamins and minerals, those kind of supplements, right? Operations, are they a vertically integrated company? Do they manufacture their own products or have they outsourced this or have they contracted it to a third party contractor? Who does their sales and marketing, right? Who are the key customers that they target, etc. Right. So I would really want to understand a little bit about Vitamin Universe. And then one thing, if you are not familiar with what are strip mall shopping centers, you should definitely clarify. Right. These are more these shopping centers are areas where you have more kind of discounted products, right? Strip malls, right? A lot of like factory outlets, a lot of sales going on, right? Okay. Now, I would suggest that you take a couple of minutes, come up with your own thoughts about how to address or approach this case, and then join me as I discuss our approach. So again, we'll break this down into four areas. How attractive is the market in which Vitamin Universe operates? Like we have a few markets in there, so we definitely want to check that. We want to understand the economics of the deal. Is it going to be an attractive deal for us? third, we want to know what capabilities would be critical for ensuring value capture. And fourth, we'll quickly talk about some risks. Okay. So how attractive are the markets? So here I'm interested in understanding the vitamin market, maybe the healthy food product market, or maybe whatever the client considers their core market. I would want to understand the market characteristics, the size, the growth rate, the key market segments, right? And what is the general profitability in this market and market segments. Similarly, on the market, I would love to understand how does the competition look? Who are the key competitors? What are their unique value propositions? What kind of products are they selling to their competitors? How many competitors do we have? Is it a fragmented or a consolidated industry? Ideally, we want to see in an industry that's fragmented, right? So that we can increase the share of vitamin universe through our own expertise, right? So that's what I would want to understand from a market perspective. Just one quick call out, and you can do it multiple ways, right? You can insert the customers bucket here. I generally like to do it when I'm discussing the company itself, but it's completely fine if you want to insert your customer bucket within the market. Okay. All right. Now, quickly moving on to the next part, which is how attractive are the economics of the deal. Here, I'm going to evaluate two things: standalone attractiveness of Vitamin Universe and any synergy potential with portfolio companies. Now, let's assume that the answer to the question, the underlying motivation for this acquisition is primarily organic growth, right? So they believe it's a very strong company. Initially, they just want to push and grow this company as much as possible, and maybe at the same time optimize some of their cost structure. And then synergies or inorganic acquisitions or growth might come later, right? If that is the answer to the underlying motivation, then the way you talk about this synergy and value creation potential will change slightly. All right, coming back to standalone attractiveness of VU, here we'll cover like the financials. So I want to look at the revenues, how they have been growing over the last few years, what is the projected growth in the future, what are their fast selling products, what are they really known for, what do customers like, right? I would similarly want to deep dive on their cost structure. I would understand what are the biggest costs. I would assume they would be the cost of operations, so sourcing the ingredients, manufacturing, or if they're contracting it to someone else, that piece. Second piece would be the stores, those the staff and the lease that they pay for the stores would be another big expense. And the third big expense I would assume would be something along sales and marketing, right? It's a CPG kind of product. I would assume that they spend a lot of money on making the public aware about these things, right? So I would want to understand how their cost structure looks and compare it to some of their competitors to see if there's any scope for improvement. And finally, on the strategic side, I would also want to look at their key IP, right? Are they known for certain, say, vitamin formulations that only they can produce? That would make the deal even more attractive, because now you would have some copyrights or patents that will protect, at least for a few years, your products from competition, right? I would want to understand the talent and the leadership in the company, etc. And then on the synergy and value creation potential, here, since it's a platform deal, I'll mostly focus on organic growth as my first and primary lever, and then I'll move on to some ideas about how can we reduce their costs, right? So on the revenue synergy side or revenue expansion side, I would want to look at market expansion for sure. So if they have 1,000 locations, maybe we can help them grow to say 1,500 locations within the next 3 years, right? Maybe we can help them expand to international markets if they're not doing that currently. Maybe we can help them launch new products, new kinds of products, maybe new energy drinks, low sugar content energy drinks, right? Or maybe different kinds of vitamins, right? So you can help them launch new products that would be more appealing to the client. You can also like help them revitalize some of their core functions. So do better pricing, right? Have better marketing and sales campaigns, right? See if there are channels to distribute online if you're not doing that already. Maybe we can have some partnerships with companies like Amazon, Walmart, right? We can strike new partnerships with other retailers that we are currently not using. But remember, there might be some cannibalization from our own stores, so we'll have to account for that. But that could be some ways in which we can help them increase their revenues rapidly. And on the cost side, maybe we can help them say product portfolio rationalization, right? So maybe we can cut down on some products that are not selling well, and that will help us save some costs. Number two, we can look at supplier consolidation or supplier renegotiation and reduce the rates that we are paying for the raw materials or the manufactured products that we are selling, right? Maybe we can do something about the 1,000 locations. Maybe we can get better real estate deals because the private equity fund might have certain connections with the players that are relevant in this space, right? So those could be some ways we can streamline their operations and help them reduce their cost structure. Right. Moving on to the third bucket, the key capabilities. So deal execution, deal financing and execution is going to be a critical one. So we have to understand whether we already have the funds secured, we have the limited partners who are willing to invest with us in this company. That is going to be very, very important. Number two is value creation plan and rigorous execution oversight. We need to have a very, very clear value creation plan for Vitamin Universe. What are the key sets of initiatives that are going to help them increase their revenues, below their costs? And then we need to have like a central war team that monitors and oversees the delivery of all of these initiatives, right? Absolutely important if we want to make this deal a success. Change management and communication. Of course, we need to inform internal and external stakeholders about the upcoming changes, what can they expect, and then talent retention within Vitamin Universe. We want to make sure we have the key like salespeople retained, right? Any key suppliers that we have good working relationships with retained, right? So providing them clarity about their future roles and responsibilities would go a long way in kind of alleviating some of their fears, giving them security and making them motivated and continue to deliver. And on the risk side, finally wrapping up with some risks, some market related risks could be change in trends, right? Customers might want a different form of consumption. Maybe they want more natural vitamins, right? New disruptive products, right? There could be new disruptive products that can completely replace vitamin supplements, right? Maybe fortified food, right? Fortified food forms that really replace the need for additional vitamin supplements, right? Any regulatory objections might also be a big risk for us, right? So that's how I would approach this case. The four buckets in for a quick summary: how attractive is the market in which Vitamin Universe operates? How do the economics of the deal look? What capabilities would we need? And what are the key risks? So that brings us to the end of this episode. I hope you found this useful, and I'll see you in the next episode in this series on consulting interview prep. Till then, goodbye and take care.